Welcome to our earnings deep dive. Today, we'll take a guided tour through Meta Platforms' Q3 2025 report. We will follow the document's own sequence to understand not just the numbers, but the business story they tell about a company aggressively pivoting to an AI future. Meta Q3 EPS year-over-year, down -83%? Why? What's the real performance? Let's read the report with Uncle G to get answers. Welcome to our earnings deep dive. Today, we'll spend the next 20 minutes thoroughly dissecting Meta Platforms' Q3 2025 report. This is more than just numbers. It's a clear declaration of how this social giant is betting its entire future on a defining AI war. Our journey will start with its powerful today, navigate through the fog of aggressive investment, and finally assess its uncertain tomorrow. First, let's hear from the CEO. Zuckerberg sets the tone up front. Meta Superintelligence Labs is off to a great start, and they lead in AI glasses. Note his phrasing: if we deliver even a fraction of the opportunity ahead. This reveals immense ambition while implicitly acknowledging the uncertainty. This frames the entire report. The company is in a vision-driven, ultra-high investment mode, where short-term financials are taking a back seat to long-term strategy. Before looking at the bottom line, we check the core engine's health. The operational data is robust, user growth of 8% to 3.54 billion. But more critically, we see the ideal scenario of volume and price growth. Ad impressions up 14% and the average price per ad up 10%. This indicates a highly effective, AI-driven advertising system that is becoming more valuable. This is the fundamental source of Meta's strength and the fuel for all its future bets. Now to the core financial data, and we see a dramatic contrast. Revenue of $51.2 billion, up 26%. Operating income of $20.5 billion, up 18%. But net income plummeted 83% to $2.7 billion. Any investor would immediately be alarmed. This is our first key signal that the story beneath the surface is far more complex. Our first critical task is to find the true culprit behind the profit crash and determine if it has damaged the company's core health. The report provides the answer immediately. This section details a one-time, non-cash, $15.93 billion income tax charge due to new U.S. tax legislation. It's crucial to understand this was an accounting requirement, not an actual cash outflow. The report itself calculates that excluding this, net income would have been $18.6 billion. This is the phantom depressing the headline profit figure. The core business's earning power remains intact. Now let's examine the two distinct parts of the business. FOA includes Facebook, Instagram, Messenger, WhatsApp, and other services. RL includes our virtual, augmented, and mixed reality-related consumer hardware, software, and content. Family of apps is the profit engine, generating $25 billion in operating profit this quarter. In contrast, Reality Labs, the future-facing bet, lost $4.43 billion while generating only $470 million in revenue. This clearly shows Meta's model, using the immense profits from the established business to fund ambitious, long-term, and currently unprofitable innovations. Such ambitious funding requires immense resources. Here, the data is unequivocal. Operating cash flow is $30 billion, up 21%, demonstrating phenomenal core profitability. Combined with a $44.45 billion cash reserve, this financial fortress provides Meta with the unique ability to self-fund its AI arms race without relying on external markets, giving it significant strategic independence. This brings us to the report's most consequential section, future investments. Management raised its 2025 capital expenditure forecast to $70 to $72 billion and stated that 2026 growth will be notably larger. Business interpretation: this confirms an unprecedented scaling of AI infrastructure. Market concerns and risk disclosure. Return on investment. The path to monetizing this investment is less direct than for cloud competitors, relying heavily on enhancing the existing ad business. Cash flow impact. Such expenditures will pressure free cash flow, potentially affecting future shareholder returns. Execution risk. There is inherent uncertainty in whether this spending will translate into a sustainable competitive advantage and new revenue streams. This creates the central investment dilemma, weighing the vast potential of AI against the immense and certain capital required. Alongside strategic risks, the report highlights explicit external threats. It warns that EU actions could significantly impact our European revenue as early as this quarter, by potentially mandating changes to its core advertising model. Separately, it notes U.S. youth safety trials in 2026 that may ultimately result in a material loss. These are not hypotheticals. They are acknowledged, near-term operational and financial risks. The positive drivers. Robust core, strong user growth and a volume-price advertising dynamic. Financial strength, superior cash generation, and a large reserve. Strategic clarity, a definitive all-in commitment to AI. The risk factors. Aggressive CapEx, intense investment that pressures cash flow and lacks a guaranteed return. Regulatory headwinds, concrete legal and regulatory challenges in key markets. Proving the bet, the need to eventually demonstrate that AI investments can create new, substantial revenue streams. Meta is a company in transition, leveraging a powerful present to build a future that is both promising and profoundly expensive. Beyond the summary, the full income statement reveals the shifting cost structure. Research and development expense surged 35% to $15.1 billion. This is the clearest evidence of the massive investment in AI talent and technology. General and administrative costs also rose significantly, partly linked to legal and regulatory matters. The top-line growth is strong, but this shows the P&L is being reshaped by one-time taxes and strategic investments, which is compressing operating margins. The balance sheet shows where the capital is being deployed. Property and equipment surged by over $38 billion since year-end to $160 billion. This is the physical manifestation of the AI CapEx data centers and servers. Despite this, the company maintains a strong net cash position and healthy shareholder equity. The balance sheet is not stretched. It is being transformed, funding the build-out of tangible AI assets. Before we finish, we must circle back to the single most important fact of this entire report. The headline net income crash of 83% was a financial illusion. The core reason is this: a one-time, non-cash income tax charge of $15.93 billion. Excluding this, Meta's true profitability for the quarter was $18.64 billion in net income, up 19% year-over-year, with EPS of 7.25. Why is this the crucial takeaway? Because it completely reframes your understanding of Meta's current health. It means the company's core profit engine did not break, it actually strengthened. This provides the correct context for evaluating its aggressive AI capital expenditures, $70.72b. These investments are being made on top of a business that is still immensely profitable. The real investment question is no longer is this company profitable, but rather can this company convert these massive AI investments into new growth engines that justify the cost? It is essential to see past this one-time accounting noise to the core advertising business's immense cash-generating power, which remains the fundamental driver of Meta's entire future. This is all for our deep dive into this report. If you feel useful, please give the video a thumbs up. Subscribe to the channel and hit the bell to join us for our next earnings analysis. We read every comment, so tell us which company we should break down next. Thanks for watching.